Hello everyone, this is Ted Bauman here, editor of Bauman Daily, of the Bauman Letter, and of Profit Switch, my premium trading service. If you look over my shoulder here, there's a little link you can click on to see my latest promotion, which is called The Final Bull Market. And that's exactly what I'm going to be talking about today, because I think it is something that obviously causes a bit of consternation and confusion amongst some of our viewers. Let me start with a message from Stephen Martin. He says, and this is in response to my video last week where I talked about the Fed and the potential for withdrawing support for the stock market and what that could do to the market. He says, so your recommendation is to time the market correctly, something which very few people are able to do. Will you be informing your Bauman Letter subscribers when to dump their stocks just prior to any upcoming market crashes? Stephen, no, I'm not going to do that, because if you listened carefully to my video last week, I made the point that crashes come and go. This would be a big one if it were to happen, but you don't have to sell all of your stocks because stocks normally bounce back. What I did say was that there are certain volatilities, certain volatile stocks that you might want to sell, to take your profits before such a thing would happen. I'll talk about that in a moment. But the key message here is that the stock market always bounces back. It always has. So when you say that I'm predicting a crash, you seem to be suggesting that that's it. The crash is it happens one and done, and we never get any stock market gains after that. Well, that's certainly not the case. My point is simply that I'm pointing out the relationship between a very historically artificial situation where the stock market has been propped up by the Federal Reserve buying bonds primarily out of the market, suppressing their yields, making stocks artificially attractive. If it were to change that, that would cause big ructions in the market, but the market would bounce back. And let me show you why that's the case. Now, here's a chart that shows the stock market going back to 1871. It shows basically the secular highs and lows of the market. Now, secular means long-term trends. So the blue lines and the blue figures show the secular bull markets, which are basically increases in stocks over a long period of time and the amount that they gained during that time. The red squiggly lines show secular bear markets and how much they lost over that time. Now, sometimes bear markets last a long time, but generally speaking, bull markets last longer than bear markets, the exception being the long one after the Great Depression going into World War II. Up in the right-hand corner, you can see that according to this chart, and I agree with it, we are still in a single bear market, bull market, secular bull market that began in March 2009. Now, that's important that I say it started in 2009, because my thesis is that we're only halfway through that bull market. If you look at that chart and you look at the length of the lines, they tend to get longer as time goes by. Now, my point in last week's video was to say that one of the reasons why we're in a bull market of such intensity is because the Fed has done a lot to pump it up. But that's not the only reason. It's also happening because we have massive technological changes. We have things like electric vehicles, renewable energy, we have artificial intelligence, we have 5G, we have all these different things going on that tend to drive the innovation cycle and also drive the rise in the stock market. So, point number one, stocks never go up in a straight line. They always have dips. But there are secular bull and bear markets, and I'm arguing that we are still in the middle of a secular bull market, that it's still going up. Now, the critical thing about bull markets is that even in the midst of them, stocks can pull back sharply. So here's a chart that shows the run-up to the dot-com boom and bust. And starting in the early 90s, you can see that there were pullbacks pretty regularly. 9% in 94, 5% in 96, 4 and 6% in 97, 16% in 98, 8% each in 99 and 2000. Now, the point there is to say that within a secular bull market, i.e. an uptrend like the ones that I illustrated but that have happened repeatedly, you do get big pullbacks. And if the Federal Reserve were to start its controlled demolition of its current framework for consuming bonds willy-nilly and forcing down yields to, making bonds more attractive, Tina, there is no alternative, then we're going to see a pretty big pullback. But let's look at that again in historical perspective. Here's a chart that ties all this stuff together, right? You see that there's downward trends. This one goes back to the Depression. You see there's a downtrend, and then there's an uptrend that starts again in 41. It's slightly different from the previous chart, but you can see big pullbacks. Big pullback at the end of World War II, big pullback in late 50s. And then again in the run-up, as I said, to the dot-com bust, another big pullback. I've circled one in 1991. That's at 18% pullback. Then, of course, in the last one, you see the last ziggy green line going up, the big pullback last year in March. So this just illustrates my thesis, which is that if the Fed were to do this, there'd be a big pullback for sure, but that wouldn't be the end of it. And that's why I think people, when I say a big pullback is coming, they think I'm saying, like, maybe some of the fearmonger newsletter guys saying that it's going to be the end of the world, it's never going to come back again. Well, there is one thing that could make for a return to a long-term secular bear market. That would be a collapse in the global financial system and or the global trading system. Either one of those or both of them together most likely would lead to a long-term decline in stocks. But that doesn't seem likely. At the moment, the world's central banks have made maintaining the stability of the global financial system their top priority. Within that priority, they know that they need to start tapering their bond purchases and then selling bonds back into the market. By increasing the supply of those bonds in the market, their yields would go up, which would mean that long-term interest rates would go up, which would mean that stocks would be less attractive. And when the market sniffs that about to happen, there's going to be a big sell-off. But it's not the end of the world. So that's the difference between calling for a crash that never recovers and a dip within a bull market. My point here simply is that I think that we are likely to see something triggered by the Fed's need to correct the current system, but it's not going to be the end of the world. You can say that about me if you like, but that's not what I'm actually saying. I know that won't convince my diehard haters out there, but I don't care. The bottom line is, when that happens, number one, I'm probably going to trim off my more volatile positions as I see the clouds gathering in order to preserve capital. Then when the crash happens, I'm going to start buying those same stocks again at lower prices. I'm going to look for value and that, basically bargain stuff. And that's because I believe that we still have another decade or so to run of these technologically driven trends. There's no way that companies in renewable energy are not going to make big money in the next 10 years. Same thing with EVs. So I'm going to buy them even after a big pullback. So you can think about me however you like, but at the end of the day, I just recognize that stocks don't go up in a straight line. If you want to call me a fearmonger because that's fine. But the thing is not to be afraid of it. It's normal. I've just shown you the history. Anyway, this is Ted Bauman signing off. Remember, if you want to, please go and look at the link below in the description to see our new offer for subscribers to the Bauman Letter. Thank you.